Perfect. So, hi everyone. Wishing a very happy new year to all the participants today, and I look forward to the great session in making. And I request all the participants, Rohit will be presenting, and momentarily in between he'll be taking a pause. At that point in time, you guys can raise your hand, and your questions we can take during that time. Otherwise, at the end of the session, we can allow some time wherein we can take your relevant questions. And those who are following Rohit for a long time know that what set of questions you should be asking. So plain vanilla buy sell or ye kya lag raha hai, wo lag raha hai, those kind of questions are irrelevant to be honest. So please respect your time and our time on that front. But I believe that on a weekend, if you have spare time, so we can believe you are a serious DIY investor. And with that note, let's begin the session. So we all know that last 12 to 15 months have been really it, I mean, we can't say indifferent. Market has been through these phases time and again, but again, for majority of the participants who came after COVID, this has been a very painful time. So let's see what we have to discuss today. So how we can navigate a grinding bear market wherein extended pain happens because the very moment you believe next quarter the things are going to improve and the market is not moving anywhere. So those kind of situations are not new, but again, with Rohit's over 2, 3 decades of experience, would love to draw a parallel like how it happened in the past and going forward also. I mean, obviously, there is nothing one perfect thing, but again, we can see that what happened in the past, we can take some semblance and see wherein we can improve in our framework. So investing is all about evolving, right? Because if it has been something definite, things would have been entirely different. But it's a cumulative human behavior which is very difficult to judge. But again, we can find our sweet spots and definitely make money in the market by staying long. So, Rohit sir, although needs no introduction, blogs which started way back were the first on value investing in Indian parlance. So, with his rich 20 plus years of experience and that too in value investing, following the legendary investors of the likes of Benjamin Graham, Philip Fisher, and other great investors. So we have had many good sessions in the past, and I think there is always something new to learn as the market situation changes. So with that note, I welcome Rohit sir once again, and maybe he can start his presentation so that we can set the tone for the session. And as and when he allow us to ask question, we'll be happy to take few questions in between. Over to you, sir.
Thank you, Prince. Appreciate the introduction and welcome everyone on a Saturday evening. Prince, just to reconfirm, we are recording the session now, right?
Yes, Rohan, we are recording it.
Okay. Okay. Thanks, Manthan. So hello everyone. We are we're going to talk about this is roughly a 20-25 page slide kind of a presentation, but I would prefer if we have an interactive session. Again, as Prince mentioned, this is not about what we can expect to happen in this current market, what ideas will work, but it is more about a framework of how you can think through such markets. Now, although we are talking of a bear market in the current context, one point for everyone to remember is that this is neither new, and obviously this is not the first time, and it will happen in the future also. So it is not something which, if you learn to recognize or differentiate, will help you in the current markets. It is also relevant from not only the entire market, but also from an asset class standpoint. And why it matters from an asset class standpoint. I think as we go through this presentation, we will get a better understanding of why it is this particular framework works across time periods, works across asset classes, works across markets. So let's get going. Again, these are standard disclaimers. Keep in mind that we are a SEBI-registered entity. Any stocks, any companies we refer to, we may or may not own them. For now, all examples are for illustrative purposes. So we are not recommending any companies to buy or to sell. Please do your own homework, right, and make your own decisions accordingly. Again, another slide of disclaimer. I won't spend time on this one. It has the standard disclaimers. So let's get started. The There were a couple of tweets I put during the early part of the year where I started exploring this idea of different types of bear markets. This was one of the tweets, and I mentioned, and I'm not going to read through the tweet. You can easily find it on Twitter, and that's what we're going to expand further in this call. So what I was trying to put across is that there are two different kinds of markets. The first type of market is a V-shaped bear market, and one of the most prominent examples of this one was the 2020 bear market. Right, it lasted, for all practical purposes, it lasted around 2 to 3 months. Right, it started somewhere around early March when it became apparent that COVID was not a passing kind of or an ordinary kind of an illness or a flu. It was more of a global pandemic. That's when the markets started correcting rapidly, and the descent was almost vertical. And then the recovery started pretty much towards early part of April, and we were close to the pre or the we were close to the start of the COVID bear market in a month or two. We had almost recovered the dr- the the drop which had happened in those 2 or 3 months itself. So this is obviously, these are V-shaped bear markets to a certain extent 2022, but more so even this year. Right, we had the the Trump tariff tantrum in the month of March and April, more or less. I think it was in April, and we were more or less through it in by the month of May. So again, keep in mind that these kind of bear markets are extremely sharp and are extremely short. And then you have the slow grinding bear markets, and these happen actually far more often than we realize. And I've given you a few examples. I'm calling the first type of market a V-shaped macro bear market, and then the second one U-shaped valuation bear market. Again, think of this as a framework and not a formula. So I've often seen when I saw it as when I made this um, kind of point on Twitter, and then people were dissecting it like a formula, that this was this, and no, but this reason happened during the this particular valuation bear market, U-shaped bear market. The point is not getting tied up in very precise formulas or reasons, but to think at a very broad level. And what I mean by thinking at a broad level is, think of a V-shaped bear market as something which is caused by an external event. There is no problem within the market itself. It is not an issue about a sector. It is not an issue. For example, think of the 2000 uh, uh, TMT, or the technology boom, which happened and which was followed by a bust, or the early 2008 real estate boom and the infrastructure boom, which happened and that was followed by a bust, right? And now we have the AI boom. So again, if it is a bear market, there can also be an external event, kind of a bull market also. So these V-shaped bear markets are caused by a macro event. It's an external event, not related to the market itself, and it causes a very sharp a dip. So during COVID, it was obviously the pandemic itself. In 2023, it was sorry, 2025, it was Trump declaring tariff, which was not anticipated by the market. And when such a large event happens, the market very rapidly discounts that particular event, which means it starts dropping in response to that. Now, when there is a large macro event, what happens is these are these are massive events, right? That is why it is causing such a dip. There is an action by the government also. Usually, globally, all governments will start reducing interest rates. They increase the liquidity, and the reason for doing is not that they want to s- uh, get the markets back to their original level or things of that sort. The main reason is to sustain the economy. Usually what happens in such cases is that this macro event is going to have a major impact on the economy itself also, and the government to kind of uh, keep keep the economy afloat and not impact the economic activity starts introducing liquidity. And the side effect of that is that the market starts recovering very quickly. So that's the V-shaped bear market. And we spoke about some of these some of these examples. You can see, right, it's almost like a V shape which happened, right? Rapid drop, and then the recovery started, and almost within 5 to 6 months the recovery was so rapid. Again, keep in mind one more thing, that the recovery during such periods, valuations is again a crucial point over there. If you see this over here, we see these sudden spikes because earnings more or less kind of disappeared during some of these points. This is a small cap index, but you can see that the valuation during the time of COVID was quite low. I mean, it was much lower than what we have now, right? You can almost see that the median index is 31, and this would have been maybe 18 to 20 times at the index level. So obviously, some stocks or a lot of stocks were fairly undervalued at the time of the COVID crisis. Another example, right? This is the Trump tariff tantrum, right? The news, the announcement around. Did I take the right screenshot? Yeah. The the announcement happens roughly around this particular point of time. The correction already started. So I will get into a little more nuance at a later point of the slide. But the correction had already started over here, and this is the period where the correction happened. But this is not as prominent. Another prime example is during the Lehman crisis, right? Somewhere it happens somewhere around here. The crash happens when the macro event happened, and then there is a recovery. The difference is that at this point of time, for the Indian markets, the correction started over here. It kept happening, and if we look at some of the numbers or the valuation, there was the market was at an all-time high from a valuation perspective. So it started correcting. And again, this just shows this is the median level, which shows what this is the valuation. This is the valuation which has which we have now. I mean, valuations have over the time valuations have increased, but anyway, that's a different point. So correction started in early part of 2008 as valuation started normalizing. And if this kind of an event had not happened, this part of the curve, then maybe we would have kind of gone sideways as the valuations got worked out, and we would have recovered. But then an external macro event happened, and that pulls down valuations to an all-time low. Valuations of less than 10 times PE, and my guess is most of you would not have been very active in the market at that time. But the index itself was below 10 times. I mean, companies like Maruti Suzuki were selling at less than 10 or 12 times earnings. Asian Paints was close to single digit. Companies like Ashok Leyland, I remember, were selling like 2 or 3 times earnings, and I'm talking of normalized earnings. So things got really cheap at this point of time. So I'll think of this almost like two legs. The first leg started because the valuations were high, and then an external level just drags the entire market down, right? So let me just pause here. We will to take any questions. We'll talk about any questions. It may not be a very neat distinction, but hopefully I'm getting the point across of what it means by a V-shaped market where some external event causes the market to crash. So Prince, we can maybe any questions from the audience, we can take that before we move into how do we address or how do we handle such markets.
I saw only one question, Rohit. Basically, you mentioned about that Trump tantrum. Obviously, that is a moving part. No one can say with certainty what is going to happen next.
Right.
But today, that Venezuela news came in. So, such kind of events can become big, or this is another event, or too early to say what can happen. And in your understanding, you being, I mean, pretty familiar with the US and maybe the politics over there. So, will when ideally this Trump thing will settle, or maybe the market discount it fully in your view? Not too exact, but some direction if you can give on that front, please.
See what happens if you have to look at these events. Uh, there is no magical point at which the market. See, the market is not as we call it, right? It's not an antaryami where it can understand everything. It's all people put together, right? People will analyze the news. I'd written a series of posts in 2000, sorry, in 2020 when COVID started happening, right? And the market had not even reacted. But if you looked at the rate at which the infection was growing, and people who were able to connect the dots started exiting the market quickly. So even the market is not able to discount such events right away. It takes time for the market to discount it. Now, at that point of time, the market is evaluating, or all participants are evaluating, is it an economic impact and is it localized, or is it across? So if you dig a little deeper, the the Trump tariff kind of event impacted exporters more than domestic companies, right? So although the market obviously corrected and it has a domino effect, it was much sharper for the companies which were impacted by the export oriented companies. And again, there also, I think the market kind of realized, or it was in its own judgment, that this impact is not so severe. If you look at, and again, no advice or any recommendations, but you can easily see how the market is sifting through it. Companies which were having a much higher export percentage, companies like Pokarna, right? We don't own any of that. So again, I'm giving a disclaimer, but look at the chart of Pokarna, right? They export engineered stone into the US market, have a very large portion of their sales coming from US. So they got impacted much more than maybe, let's say, a Maruti Suzuki or a Coal India. A Coal India has hardly any impact. So the market tends to distinguish in that. If you look at the event which has just happened, right, where US has more or less invaded Venezuela, will it have an economic impact? We can always have a moral argument or an argument that the US is behaving like a bully and a hegemon and is going and invading other countries. But then you have to think, what does this event mean in terms of companies and their earnings? That's all. It eventually comes down to that point. Venezuela is a fairly closed economy. It does not export much. Oil is the only thing. So does oil spike that much? Again, I don't have an answer, right? Does this cascade into a global crisis where US gets challenged by China? Those are unknowables. We do not know what will be the reaction of the other bigger countries. And again, it's mostly about China. So very difficult to say, but at least the first order effect is oil. And how severe will that be? Will there be a disruption in oil? Again, Venezuela produces oil, but it does not produce as much oil. It's a more of a geopolitical thing where China and some of the other countries, you know, uh, import oil from Venezuela. So it's often it all depends on how events play out. And although we see some of these events which have caused these sharp V-shaped responses, it was in a more in a rolling fashion. Often these events will dissipate, and as a result, the market would just kind of shrug it off and would move on. So nobody can tell. It's a matter of time, and it depends on how bad the event. It's more obvious in hindsight or in retrospect than in real time. Any other questions, Prince?
I think we can go at Rohit.
Okay, sure. So, what's the difference between handling this kind of a market and maybe what the market which we have now? I think what happens in such kind of V-shaped markets is that you have to have the courage to buy at the bottom. Again, when I'm saying the world is falling apart, you can have a very major event like when we had during COVID or when we had during 2008. That world can be falling apart from a sector standpoint, from a few group of companies standpoint. So don't it's not just about the entire market crashing. It could be even a sector, because that particular macro event causes a particular sector to collapse. You need to have optimism that this issue will resolve. The world will not end. See, that's very important when you are investing in equities. One of the very common things which happened during COVID, and people forget that, was that during the depth of COVID, there were very serious concerns in terms of how long will this illness take to recover, and will, with a complete lockdown, no economic activity, if we kind of assume, or we kind of think that, oh, the vaccine was just around the corner and things would have all worked out. But if you remember, and if you were involved in looking at the events very closely, till then any new vaccine had taken 3 to 4 years to get discovered and to kind of get developed and to get introduced. That had been the technology till that point of time. It's basically the mRNA technology, uh, which allowed companies like Pfizer and some of the other companies to very quickly come up with a vaccine, and then across the globe, countries basically just went and produced and distributed this vaccine on a war footing. But prior to that, right in the depth of the event in April and even in early May, it wasn't very clear as to when we will have the vaccine. So obviously, at that point of time, any investor needed to have some sort of a I wouldn't call it blind, but to some level, you need to have that faith in the society and in people that this event will eventually get resolved, and we will not get dragged into a multi-year depression. Keep in mind that it is not a given. Events have happened in the past, which is way back, maybe 100 plus years back. There's a very good book around the 1929 US crash. Read through that. People thought that it would get resolved, and it did not, and it dragged on. So it's not a given. But if you assume that this event is not one of those and it will get resolved, then you will be very handsomely rewarded. Again, at this point of time, stock picking is not critical. It's more your innate optimism and how much of a iron stomach you have, that is more important than being able to pick the right stock. Everything is kind of just bombed out at the depth of the 2020 COVID crisis. The market itself had become fairly undervalued. So all that you had to do was just go from cash into equity, which very few people were able to do, and it would work out. So speed is the key at such points of time. So let's move to the current type of markets, right? And this is something which is the subject of this presentation also, and I'm calling it the grinding U-shaped bear market. Again, started with a tweet. Uh, Initially, I think the market, usually in these markets, we will have a drop, and you will lose money, and from your all-time high, most investors would lose 10, 15, 20, 25% during the initial phase. Now, if you're expecting this to be a quick recovery and then the market moves sideways, that's when this stage two starts happening. Right? From an all-time high, you've come down by 20, 25%, and you're hoping for a quick rebound, and the market just keeps grinding. and slowly, the optimism or the positive attitude starts draining away, which seems to be happening now. And a lot of people will clutch at straws and would hope that this quarter this will change and hence the market will recover, but you never know. Sometimes it does, sometimes it doesn't. So what are the characteristics of these kind of markets? So one is, I'm calling it endogenous, which means it is not linked to outside events. The start of such bear market, think of when this correction started in the current market, right? It started somewhere around the late part of last year, early part of this year. There were no major event which signaled the start of such this bear market. Slowly you will see correction starts happening in certain sectors in some companies, and it starts spreading out. So it's not a very sharp event that one fine morning there is a major news which gets announced and the market drops 10, 3, 4, 5%, and then the crash starts, which is what we see in these event driven markets. The market corrects and then it keeps correcting. Here you will have two steps back, one step forward kind of a situation. And usually the cause of these kind of bear markets is valuation. And what happens in such markets is that it's a slow, prolonged correction, and liquidity just keeps draining out as more and more participants leave for various reasons, right? We've had FIIs selling, and the government usually, till there is an economic impact, has no reason to respond. So it's not like the market is down by, let's say, 10% from its peak, and at least the Indian government would then start pumping liquidity into the market to revive it. The economy is doing kind of okay, right? It may not be doing gangbusters, it may not be growing very rapidly, but even that may not be the case. The Indian economy has done fairly well this year, right? In spite of that, the market is correcting. And usually in these cases, you can see it's because of valuation. And why do they occur? It's, if you have to think of anything, it's valuations. And if you just expand your thinking on that, it's not related to markets alone, right? We have seen the same thing happen all the time with individual companies. We have seen that with sectors. When any particular sector gets overstretched, it will go through a long phase of, in investor parlance, it's called as, fundamentals catching up with the price, right? And often that will be the case with these kind of bear markets also, right? And I've taken very long kind of a valuation history of mid cap 100. Now, although the average trend has been up, you can see these cycles, right? Valuations, this is 2008, right? Appears much lower, but look at what happened, right? The initial phase, the correction happened because of valuation, and then an external event dragged it down further. And from there, there was a recovery in the valuations. This is roughly around 2011 time frame. And then again, correction keeps happening, and then we get to end of 2014, where you then have a massive bull market going right into 2018. And those of you who have maybe studied history or would had participated in the market during that time, a lot of people made a good, very good returns during this 3 to 4 year period in mid cap and small caps. And roughly around the January 2018 or 2000, early 2018, again, mid caps and small caps had become all rage. And then see what starts happening, right? Correction continues over here, and then suddenly there's a huge external event. So it's not that everything is very neat and very nicely laid out, but corrections will happen. If there is no external event, it may be settled down, but an external event can cause a further V-shaped market also, right? Let me just pause here, Prince, if there is any question on in terms of the distinction between these two type of markets, because this distinction is what drives our response to these kind of situations and how we think about it and how we should address it. So any questions from the audience?
Yeah, yeah. So Janak is asking, would the number of individual investors active demat accounts plateau or dip in a U-shaped bear market? Is this a good indicator? And which is the book you referred about 1929 fall? These two
Yeah.
questions.
Let me get to the second question first. There is a book very recently. The name of the book itself is 1929. Right? I think it is Andrew Ross Sorkin or something. I'm forgetting. My maybe he's a CNBC presenter. So just Google 1929, and I would highly recommend everyone, if there is one recommendation or maybe a series of recommendations I will give in this presentation, are books. Uh, you have no downside in reading these historical books about markets. So read that book 1929, a real time kind of a um, uh, uh, kind of a picture of what happened in the market, and you will be surprised to see so many parallels in the current US market and maybe even in Indian markets also. You know, the caste changes, but the average type of investors and people do not. So anyway, that's 1929. In terms of number of demat accounts, you don't even have to get that fine grained. Obviously you can very easily see the impact of such market from the price and the breadth action itself. The price keeps dropping, but more importantly the breadth of the market also starts dropping, right? So oftentimes the the broader market may not be dropping as much, but individual stocks keep dropping. Like we have seen in the last 2 to 3 months, the market depth has kind of sorry breadth has kind of just been dropping continuously. So although the index stocks may kind of tread water, but a lot of other companies which are not in the index are slowly being sold off, and individual portfolios start getting impacted. And that's where people start losing their patience as more and more stocks just keep dropping, right? And we have seen that in the past also. Saw that during earlier corrections in such kind of markets, versus a V-shaped market where everything literally just drops, everything just collapses. There's no distinction because it's more of a liquidity cascade, right? The liquidity is getting sucked out and everything is getting impacted. Versus in a U-shaped market or this kind of a grinding market, people are not scared. They're just getting frustrated and they're losing hope. So after a certain point of time, if someone has expectations of, let's say, 30% CAGR, and then they realize after a year that their portfolio has made no progress, they just get exhausted, they just get tired, and they slowly start selling their portfolio of or their stocks one by one till they maybe are completely out of the market. So that's what I mean. You get ground, you get chopped, or you get you get ground out of the market itself.
And
Any other
Rohit, one
question?
question, yeah, one
Yeah.
question is on China. So basically, the person is asking from last 6 years he has been investing, and he's seeing that China, being the largest manufacturer of so many things, has been dumping across global markets,
Right.
and the monopoly is there, and the other markets are not able to compete owing to the margins and the scale which China
Right.
has. So he's asking like, was it the same in last 15, 20 years, or it has been like this recently, and going forward, some view how it can change in parlance with Indian markets?
So this gets a little more complex and nuanced. Couple of things which have happened with China and which may even change also. I think we should look, we should watch. We have to watch China closely at all points. Anytime it enters a particular industry. So the point number one is that the Chinese system, it's extremely competitive and hyper competitive, right? The most companies don't even look at ROCE. Overall, if if you pull up the companies outside of their the equivalent of FANGs like Baidu and Alibaba and maybe Tencent, EV companies, solar companies, battery companies, their return on capital is extremely low. It's just brutal competition. If you watch the movie Hunger Games, it's almost like a Hunger Games scenario. What that means is that they barely make any money in their own domestic market. So whenever they start exporting, if they we talk of them dumping, and we talk of the Chinese government kind of supporting them, that may very well be the case. I don't know that for fact. But if they export, let's say, into a US market or an Indian market, uh, passenger car, or let's say an EV, or an automotive company may be making, let's say, 15% return on capital in India. That's what the market is supporting in India, or maybe in the US. A Chinese car company is making 7%. So for them to drop the price, they're still, their overall aggregate ROCE goes up. So that's the reason why they're dumping, or they're pushing a lot in the other markets. Now, when you make, there is a study which maybe I put a tweet also, where the two best performing markets are India and the US, because the average ROCE of the Indian and the US markets have been among the highest in the world. So markets don't care about, in the long run, don't care about your engineering prowess, what whether you're a rising economy, stagnant economy, etc., etc. If your companies can grow and can make a high ROC, the valuations will remain high and you will get returns. It's as simple as that. You have to strip away the narratives. The Chinese companies as a whole, outside of a few companies, have not done that. So we may want to get into politics and all that, but you have to keep that aside and think long term, that that is what has happened. Now, as long as this continues, obviously any industry which they target, that industry gets impacted. So that is true now. Coming to the question, that is true for India also. What is maybe, and that is just my interpretation, what is now changing across the globe is that most countries are no longer as tolerant of this kind of, you can call it economic imperialism, or whatever, whichever word we want to use, right? US obviously, after maybe 2 decades of acting in this way, decided, we will not allow our industries to get decimated in the same fashion, and India is also doing the same. So this whole approach of exporting and at cheap prices, mind you, the products are not bad, but again, the just because of their efficiency and their size, they're able to decimate a local industry, and I don't think most countries will now be comfortable with that. Countries like India and other countries have started pushing back, and China, I think, if you look at the recent news which has come out, they have started looking at consolidating their own industry also, so that they can earn a slightly better return on capital. They know that they cannot keep doing this, right? They cannot kill the entire car or whatever automotive industry across the globe, and countries will not just allow that to happen. So that's my read. We will see an improvement in terms of the profitability of Chinese companies, and obviously reduction in tensions because of that. So anyway, I think that's my reading of how the Chinese markets and how these companies could respond. You should see the price action of the Chinese index just late last week, after this news came out from the Chinese Communist Party of how they are going to allow industries to consolidate. So just keep an eye on that.
All right. So two quick questions, both are on behavior. Jivesh and Kashif, they have asked. So one is like how to manage a 60% drawdown in your portfolio emotionally. On paper, even after knowing that it is a good time to buy when the markets are bottoming out. And there is a lot of fear mongering and stories built around how things will come to an end. And secondly, like for such
Mhm.
drawdowns, we need to bear the pain rather than trying to time the market. So is it the right way to go about it?
Right. So first of all, a 60% drawdown in a portfolio, I I can honestly just say, at least on my personal front, that I, even after so many years of investing, it is going to be close to impossible at that point of time to handle it. It is not easy. No matter what anyone says, when you lose money, it hurts. A 60% drawdown will hurt, will hurt a lot. It's very, very difficult. If you can just hold on to what you have at that point of time, that itself will be, will be a miracle, to be able to put money. And that also explains the reason why the markets are obviously crashing, right? When will you get a 50% market crash? Even in the worst of the macro kind of events, markets don't crash as much. It has to be a really horrific event. We saw it with COVID. You can almost see such events happen maybe once a decade or once in 2008, 2009, 2010. you have to practice proper asset allocation even before you get into such markets. Right? If you are 100% invested, assuming that you will be able to handle such kind of a drawdown, then unfortunately, I think I have to make a blunt assessment that you have not read history. And I'm not pointing it to this individual who has asked the question. I'm saying, for investors per se, you need to study history and realize that a 60% drawdown will happen at least once or twice in your lifetime. You can't time it. You will not know when it happens, but it will happen once or twice in your lifetime. Can your mental capital, will you be able to retain your mental capital? Will you be able to retain that positive attitude even during such a drawdown? So by maintaining proper asset allocation, at least you can reduce the brunt of that. Second is, as these kind of corrections are happening, let's assume you are even over allocated. Maybe you have to, if you're an active investor and if you're really allocated to that level, then you have to take an active action at that point of time. For example, during the 2020 COVID drop, we started exiting from my personal portfolio, and for our clients, we started exiting because we knew that at the bottom of such a market, if you have lost a substantial amount of your capital, it's very tough to even hang on, much less add further to it. So obviously, right, the action needs to start much early, and you need to practice proper asset allocation. I think that's where that's why I mentioned in that point, right? It's all about courage at that point of time. Analysis does not matter. You can pretty much just throw darts on the on the stock list and pick up any stock, and it will work out. Does that answer the question, Prince?
Yeah, perfect, Rohit. We can continue and then we take questions again when you pause
Sure.
next.
So again, right, if you have to understand the distinction between the two, I'm coming back again, reiterating it, because that in turn drives how you will handle the two markets. When there is a macro event, valuations don't matter, and we can see that partially during the 2020. Let me go to screener and let me know, Prince, if my screen is visible properly as I switch to.
Yeah, we can see that.
You can see, right? So let's go to the Nifty mid cap. Let's look at what happened, right? So let's look at 10 years and let's look at the PE ratios, right? So let's look at during the COVID period, right? This is, this is the peak of the in terms of valuations. Look at where the valuations were in 2018. Now people say ILFS, this, that. Doesn't matter. Even if ILFS had not happened somewhere around here, right? This is the ILFS. It's a little bit of, now because of so much time has gone by, but the index was 47. Again, it's not very formulaic, right? It's not like, oh, 40 times earnings. This is on average, right? That's what we are talking of. Think of it like a zone rather than a precise number. This clearly was in August 2018, or that late 2018, or sorry, mid 2018. We were clearly in a zone of higher valuations, right? If this is roughly your median is roughly around 30, at 60 times we were at least 2 sigma above the median valuation. So clearly a lot of stocks were overpriced, and that correction started. And the valuation started dipping, right? The market tends to oscillate around its medium over the long term, and that is started. And we can see that by roughly by towards the later part of 2019, we were getting to that point. And then COVID happens. And then it did not matter what's the valuation of the market. The entire market got dragged down, right? And then sorry, I'm pointing to the right one. This is over here, right? The value, actually the market was fairly undervalued, by not fairly undervalued, but it was below average valuation. It was almost at 27 times earnings, and then COVID happens and it drags the market down to a 10-year low. Even if you go to the option where we look at all-time this was March 2020 was almost like a like a 10 plus year kind of a low. And then obviously the earnings disappear because of COVID, which is why these numbers are not very useful. But as soon as that particular external event starts dissipating, the market recovers. Counterfactually, if COVID or such macro event had happened around this particular zone where there is too much of overvaluation, the correction would have been severe, but your recovery would not be as fast because the market is still not cheap. So thumb rule or kind of a thought process for everyone to keep in mind is that if you have a huge macro event which coincides when the market is undervalued, the recovery is much faster. And we have seen that across. If it is the market is overvalued and a macro event happens, the correction will happen no matter what, even if the event did not happen. But the recovery will not be very fast because you don't have value buying coming in. So that is what, if you look across indices, that is the kind of the key message you should take, that these kind of long bear markets are basically the market correcting the overvaluation. Valuations now kind of getting towards the median, and that is what is happening even now also. Again, we can I've put a few examples, right? There was this particular slowdown, and we can see, right, 2021 the valuations were not too very high, but you can always, it need not be too sigma. I mean, the higher the valuations go over the median, the more the correction. But anyway, what we saw during the 2021 was kind of a bit of a prolonged correction. And why did we have such a good recovery, or you can say returns, from the bottom of 2020 2023 market? And I'm assuming most of you would have been around it, but is to look at the valuations. They were fairly low, 15 times earnings on this particular index. And I think I did not take the screenshot of the index, but maybe I think this is the mid cap 100 itself, right? So fairly low, and now it's roughly around 30. So we are now at roughly the median valuations, and it went pretty high during the early part of 2025, right? It was above its median. Take the example we just spoke about, the 2008 the event, right? Now again, if you ask anyone, people will say ILFS crisis and NBFC. Usually when you're thinking about such situations, I know there was a question around uh, the recent news which has come up, right, where US has attacked Venezuela and all of that. Often these become the narrative which is used to explain the correction. But independent of whether that event happens or not, the markets will start correcting because of overvaluation, right? Buyers slowly start realizing that some of their stocks are extremely overvalued, and then they start exiting, and then slowly it just keeps happening. So the ILFS crisis happened towards September, October, kind of October 2018, but the market started correcting from the beginning part of the year, and you can see that the valuation correction had already started. Same, this is way back. This is roughly around 2011 and 13, where we had this. You see this. This is very similar to what we are seeing now, right? An initial phase where the market drops from 2011 peak to 2012, and then the market just goes sideways. And then if you study the history, I just pulled this off ChatGPT. Said, give me an explanation of why this happened, and it will tell you what was being thrown around in the media. There was this whole eurozone which had too much of debt, which caused weak foreign flows, etc., etc. This is just narrative, right? If you look at the valuations, that tells you a more detailed picture. Valuations had now. Should valuations have gone here, or would it have gone here? There's no formula, right? It's not like at X valuation after 2016 it has gone much higher. So there's no clear cut, but what you can think of is zones. As valuations start exceeding the median and they start going up, the gravity starts building. It's a matter of time where the correction will start to pull the overall valuations down, and that is what started happening. The valuation started dropping, and then as valuations kept going down, you're setting up a condition for the market to recover. And we see that in sectors and even companies also, right? I know we're talking of the market, but pull up the chart of any company. Common example is the transformer companies and EMS companies now, right? Oftentimes the numbers will be very good, But the valuations have gotten so stretched, they are now at 70, 80, 100, 150 times earnings. Classic example is Asian Paints, right? At a certain point, the valuations get so stretched that even if the company does well, the stock doesn't go anywhere because, as you know, I mentioned a few, a couple of slides back, that the fundamentals are now catching up with the valuation. And that is obviously if the company continues to do well. At company level, it varies, but market level, earnings will keep increasing. So that's the key point to keep in mind, that these will be slow. These kind of bear markets are a process. They are not an event, which means you cannot time it precisely. You cannot say this is when the valuations will hit X and then the bull market will start. Prince, any questions from the audience?
Not for now. So Rohit, we can continue.
Mhm. So the first thing we will start with is what not to do in such markets. I just mentioned this. Don't make any historical projections. You will see that in social media a lot. This bear, and I used to see this at the beginning of this year. A lot of people were saying these markets will last 15 months based on some analysis, and they will go down 18% before they recover. There is no statistical validity. 5 or 7 data points do not make a rule. I mean, you can always say it happened this way in 2011 and happened, and I've shown you the data till now, right? In some cases, the bear market started where the valuations were just a little bit above the long-term medians, and sometimes it kept going on for a much longer time, and then obviously the correction lasted much longer. So if you have to make an assessment, think of how much above the median we have gone, and that has happened now in the recent years. Markets have stretched to the upside far more than the past, which means the hangover will remain longer. Again, I've mentioned, don't confuse them with a V-shaped bear market, because if you expect quick recovery, you will get disappointed. And finally, uh, we had a lot of momentum and position trading, which kind of became very popular from the trough of 2020. But that was because it was a very good trending market which we had. So in such trending markets, momentum and position trading works much better compared to these kind of sideways market, which are not very kind to momentum kind of trading, because momentum does not last enough and you get chopped up. So if your investing style is around that kind of a factor of momentum, then you have to wait. Either you switch your style, or you have to wait till the market again gets into a new bull market. So this is at least from a what not to do perspective. So let's get into um, what we should do, or what an investor should do during such periods. So first thing is, have patience. uh, don't get caught up in narratives which says by so and so date or so and so time period. And we'll get into a little more specifics as we go along. It's easy to say, be patient, right? But then what do you do if you are an active investor? We'll get into that. um, Look at bottoms up ideas, right? Don't You can look for themes, but oftentimes you may find some sub themes which are working, but they don't work as well, right? So look at some sectors or look at some themes, but start working in that fashion. The market will not carry your portfolio along. You'll have to really work hard, and you'll have to really grind it out to make progress on your portfolio. And then finally, if you're not getting price signals from the market, you have to measure a progress differently. Again, I'm putting these three bullet points. We'll get a little more detailed into each one of them. So why should you have patience? Like, is it a am I saying that from a virtue standpoint? No, it's not that it is some noble trait which you should have. It's the reality of the market, and for that reality to play out, you need to have patience. You have to wait. And the reason is that valuations are high, and they will revert to the median, or they even shoot to the downside as your earning kind of catch up. And you can't, no matter how much you want that to happen quickly, the market is not going to behave any which way which we want, right? It can be a long drawn process. And if you have to look for examples, look at the hot sectors of the past. We've had chemical, defense, pharma. We had a chemical sector boom right after COVID, right? And then it's taken years and years for that sector to settle down, and maybe who knows how much more time it will take for the sector to come back. That also happens as far as the markets are concerned. Obviously, the difference is that unlike a sector, a market has far more sectors, right? So, which is where this point comes in, where if one sector is not performing, some other sector can carry the market, right? And that's where this whole uh, comment comes, where what carried the market in the last cycle will not carry it in this cycle, because some sector which has now gone out of favor now starts picking up, and that carries the market. So in that sense, the market is different, but the the mechanism is the same. Okay, so second is do bottoms up work, right? The point is that even in the worst of the times, there is a bull market going on somewhere. You just have to kind of keep digging and keep working harder. And we saw that during markets like 2018, where quality stocks started doing well, and 2022 and 23, where towards the later part of 2022, some of these sectors which became the darling of the market in 23 and 24 started setting up and started showing some early signs of improvement. And we'll get into specific examples. But we saw that in defense, we saw that in PSU, shipbuilding, and all of that. And then 2025, of course, right? Everyone has been talking about gold, which obviously you're going into other asset classes and select companies. What I have not put over here, and what I think all of you can think of, is from an international standpoint. Again, I don't mean that you should start picking up AI companies or things of that sort, but I know, and I keep hearing that people have now started looking at foreign markets. There are options of how you can, not options as in FNO options. I'm saying, the capability to invest in foreign markets now, either through ETFs or indirectly. That is again another venue for people to explore. Where if the Indian market is moving sideways, you can maybe find another market via an ETF or individual stocks, where that market, after being cheap for a very long time, now starts doing well. And that's another diversification. So keep in mind that some market is doing well. It obviously requires more work. You cannot do lazy investing, but if you're really up to it, you can get your portfolio to perform. Um, how to, and we'll get into a little bit more step by step with a real example. But how do you do that? Try to identify companies which are reasonably priced and growing. Right. Again, very generic statement, but we'll try to expand on it using some examples. Second is, if you have losers, let's say you bought some companies which were doing very well in the last bull market, you kind of got carried away a little bit, exit those losers. You have to be brutally honest with yourself and with the portfolio. Don't wait for the market to recover and then hope that your stocks where you've lost money will recover. Sometimes the best option is start exiting the losers, because maybe you bought them at the wrong time, or the market has changed on you, or that particular stock has changed on you. Just exit them, replace them with companies which you are now identifying. So in summary, I think you have to work really hard to generate this alpha, and we'll get into a little more examples. So let's switch into a few examples. And again, keep in mind these examples are for illustration purpose. I and my clients don't hold any of these companies which we are talking of over here, but this is mainly to explain or to illustrate what I'm saying. Before we dive a little into these examples, any questions, Prince, from the audience?
Apurva Sharma has raised his hand. I think I have allowed him as a speaker. Can he try or? Yeah,
Yeah,
Apurva,
but
please quickly.
Hello, everyone. Thank you so much for letting me ask the question. I just wanted to ask, How on a broad scale in markets do you define an overvaluation? Are we seeing this market stretched from a global perspective, that if you just see across the whole world, we are today the most expensive market? So
Right.
are we seeing overvaluation in respect to economies, or are we seeing overvaluation within ourselves? How do you measure this?
Right. No, that's a good question. I personally have not compared it with other countries because each country has its own nuance, right? And it's uh, for most of us and most Indians, we we cannot, because of our individual situation and also the government restrictions, we cannot move capital from the country to another markets. I know people and some mutual funds are doing it, but it is capped. So just to take an extreme example, the Korean market was one of the highest performing markets this year, and surprisingly, even the Karachi market was one. Right now, let's keep the politics aside. Most of us will not invest in the Korean or maybe even the Karachi market. So the the real the consideration set is not really the broader market. Maybe US markets people can invest, but the consideration set is still the Indian market. So with that situation, the overvaluation which I am talking about is with the market itself, because that's maybe 99% of what we all of us as investors can access. Moving across borders is only for the foreign investors, and FIIs obviously are playing a big role. But I think in the last maybe 5 years, as we have seen the stats, right, the domestic investors have become a much bigger influence with the kind of selling which FIIs have done. In the past, prior to let's say 2010, most of you may have not have been around, and even before that, the moment FIIs to sell, there used to be like panic. Like people would watch what FIIs were doing very closely, and you could see day-to-day impact. These days, not as much. Our own mutual fund investments, individual investors, the impact of FIIs is much lesser. So what happens is that has elevated the long term valuations, if you may. Although this chart from Screener shows median valuation of 31 at Nifty Mid Cap 100, but believe me, if you go back and I don't have the data over here. It's there in my spreadsheets. But if you look at maybe this part of the market history, the median valuations used to be sub 20. It will be somewhere around this range. So average valuations have gone up. So I'm looking at the recent history. So over here, if you look at this particular recent history, again, coming back to the same point, think of it like zones. Again, it is not a formula. You can see over here, right? After the 2021 COVID response, our valuations were in this zone, right? 2022, 23, and then towards the later part of 23, earnings started improving, and we were fairly, undervalued. Now, as we get into 24, the valuation starts stretching. You're getting into this zone where we are versus its own history. I'm not talking of comparing it with China. I'm not, because every country has its own idiosyncrasies, its own situation, right? As we just said, right? The ROC, average ROC of Indian markets and US markets is among the highest. Chinese markets is the lowest. You cannot really compare. Can we compare with Japan and South Korea? Actually, really not, right? Both Japan and Korea face a huge demographic headwind. Those, in a country where adult diapers are selling more than children diapers, you know, no matter how much, whatever we may find it funny also, but unfortunately, that's the reality of a lot of developed countries where the total consumption driven demand is slowly going down. So if that is the case, very few companies can do well, right? Whereas in India, the consumption is increasing. So it's more around comparing with our own history, and you can see this zone of overvaluation, if you may, right? And that is what is correcting now. We are getting into the median. Will this go up again? Will this go down? Million or whatever $1 billion question, right? Nobody can say. It cannot. Nothing prevents the market to get into this zone, right? It is been there in a history. Can any one of us see a specific pattern? There's no specific pattern. Nothing says that the market cannot get into this zone, which is what. Even a long-term average is another 15-20% drop. So again, I'm not trying to scare any one of you, right? All I'm saying is you cannot estimate a probability of saying this is how much the market can drop. It can very well drop, it may not even drop. But it is definitely in the realm of possibility that the markets can get into this zone of valuation either through earnings growth and the market continues to move sideways.
No, I agree, Rohit. I mean, I'm a registered analyst myself. My only and I'm with the view that you just mentioned. Since we are very bearish on Indian markets, and I have no two thoughts about saying that also. My only point of getting a view from you was, do you think the Indian investors, be it a FII who are investing in India,
Mhm.
big investors like Mr. Kedia, are you ready for a range market in Indian economy if a range comes to 3 years, for the next 3 years?
That we'll have to answer for ourselves, right? If people who are not patient will exit the market, and then people who are patient are the ones. See, FIs are moving money around. They have a different mandate. For them, India may be a few percentage allocation. They will move their money around. So they are not really comparable to people like you, me, or most Indian investors. For us, for the rest of us, if we don't have patience, then we'll pay the price for it, right? The market is not there to accommodate you, me, and all of us on this call, right? It will do what it has to do. The best you can try to do is to look at other asset classes if you are ready to put in the work, or look at other countries, and that may very well happen also. People will start looking at international investing subject to whatever caps we have. But if we are not, and believe me, that has happened quite a few times in the past. We don't even have that history, but I have personally gone through the 2001, that kind of dates my age, but 2000 to 2003 bear market, and it lasted 3 years after the dot-com bust. So it's in the realm of possibility that we can have an up and down market for the next 1 or 2 more years. And those who don't have patience will miss the upcycle and when it comes, right? Because oftentimes these corrections or these long bear markets are followed by a sharp 30-40% pickup, and a lot of money is made at that point of time, which a lot of investors miss out. So
Thank you, Rohit.
sure.
So, a couple of more questions. So, one Ravi question is basic one: how to analyze a company. So, Ravi, I can route you through previous session with Rohit where we have discussed this. So, Abhishek has asked, in a bear market, should investors move entirely into cash or remain invested? Additionally, if the index P remains above its historical median for an extended period, does it make sense to increase cash allocation, or is it better to stay invested? So, good question, Rohit. And on the same question, do you believe that we have to, I mean, see P in parlance of the present situation rather than always considering the median, or the median will keep on
Right.
increasing? What is your view on that?
No, there are great questions. I'll break it down into two parts. Let's get into the discussion around P. I want to emphasize this point for everyone. Um, and I put this in the beginning of the presentation. I'm using P as an illustration. Do not, I've seen this kind of analysis where people will say, this is the P of the market, and hence you should take this action based on this P of the market. So let's first of all take that entire element of decision making based on the P out. Again, I'm using P as an illustration to show what is happening. There is no, you can see this from the data yourself. There is, this median is just an average of what has happened in the last 15 years, right? Should it be 20? Should it be 18? Should it be 40? There is no rule anyways, right? What it just shows that this is a zone of overvaluation, or it is overvalued compared to its recent past. So that's point number one. Coming in terms of how you can make decisions, right? If this is just from an understanding standpoint, I think the second question was how you should make decision. And over here, I'm personally a big proponent of asset allocation. Uh, Again, our individual situations may differ, right? But I think as an individual investor, the first a decision we should all make is what is going to be my equity allocation, what is going to be my debt allocation, if you are okay with commodities, real estate, etc., etc. And at least I personally would, my preference would be, again, it's not advice, but my preference would be, if you're, let's say you are, and my assumption over here is everybody on this call is an active investor, because if you were only in mutual funds, then you are delegating that decision to your fund manager, and in such cases the best option is just continue to do your SIP, and that's actually a good idea. But let's assume all of you are bottoms up individual stock pickers. Make that first call of what is your asset allocation. Let's just make a few numbers up. Let's assume that you are a um, you know you're an active investor, and let's say you invest 70% of your portfolio in the markets. Now, as you were investing, let's look at I'm just pulling up mid cap 100 just to make a point. Let's say by this particular point in the market, after you started investing post COVID, you started, let's say, in post COVID at, let's say, 65-70% of your portfolio was in equity, and the market kept going up, 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 and by here you have now hit 80-85%. So start doing rebalancing of your portfolio. You don't have to make a call, is the market high, what has happened to the PE, this, that. You don't have to do that. Just practice asset allocation. You can do it once a quarter, once in 6 months, once a year, whatever that is, and do that asset allocation over here. Because your equity has become overweight, do over there. As you get over here, maybe you have brought down your asset allocation to 70% by this time. When the market crash happens, this kind of a drop happens, maybe the asset allocation is dropped to 50% or 55%. You can then increase your equity allocation. What you buy in equities, if you are a mutual fund investor, SIP takes care of it. If you're a bottoms up investor, maybe you will find ideas at that point of time, independent of the market level, will give you that 10% which has now gone into another asset class can be moved into those equities. So that's how very broadly I think of. I'm looking at the market levels, but the way to make a decision is not to look at market levels. This is to give you a context of what is happening and to adjust it through asset allocation versus saying I will go totally into cash. That gets into market timing, and you can look at the history. At what point do you say the market has bottomed out? Look at the history from 2010 to 2000 whatever 2015. If you said I will start investing when the PE turns 13, you would have missed out this entire phase, right? From 2016 onwards, you would have always been in cash because the market average P's have just gone up. So hopefully, Prince, this answers the question, right?
Yeah, it does. So a couple of more questions. So Rohit, shall we, continue with the presentation and then I ask, or shall I ask the question now?
Let's go ahead. We'll get into a little more, less of presentation, more of showing everyone dynamic examples of how you can look at such companies, right? In a market like now. So let's address this question and then we can move into those specific examples.
Perfect. So Kaku Goyal is asking, like, his question is regarding the median valuations, considering the bond yields which has started to hit 20-30 years high in some of the countries.
Right.
What could be a correct time period for median valuations, or is it just a tool to sense rather than being accurate?
I think you answered the person who asked the question has answered it, his own question. It's more just a sense of where the market is. I know there are individuals and there are investors who do or academics who do fairly elaborate equity risk premium based on yields and all that. Personally, I don't get into that because the place where I'm coming from for this answer is that I've used this as an illustration. But if you're a bottoms up investor, I'm looking at the company which I hold, and there you can get far more granular. Let's take an example. For example, if you had invested, let's say, in an EMS company, right? Again, I've never bought, I've never, I don't hold it, but we'll just pick one, as an example, just for illustration purpose. The same concept holds over here, right? Look at this and look at the PE ratio. So let's maybe take it as 5 times. I'll not get into the absolutes over here, but similar cycle we see at a company level, at a sector level also, right? Initially, this P has gotten adjusted because of these spikes, but maybe prior to 2024, the median Ps would have been roughly in this 40s range, right? This is what used to be. Let's say you were one of those investors who bought this stock. Again, uh, please keep in mind the disclaimer, right? Want to emphasize that. I don't hold it, nor do my clients. We have never held it. So let's say you bought at this particular zone, on this particular price, right, which is somewhere around here, right, based on what was going to happen. Now, when you bought this from a 200 level, you have made a 5-bagger. As you are analyzing this company, you don't have to worry as much about the market, right? I know we spoke about interest rates and median, but that becomes far more analyzable at a company level compared to a market. A market is composed of 100 stocks in the case of mid cap 100, right? Very tough to make a judgment call because the constituents keep changing. One important term is called as non-stationarity of data, which means the constituents of the index changes. So if you get asset-light companies, average P should be higher, right? If you cannot really compare the index from year 2000 or year 1995 with the index of 2025. Companies are different in that index. So that's where it gets a little tricky. But when you see that happening at the market level, you, as an active investor, you should also start looking at your own individual stocks. And when you see that the late 2024 is coinciding with the market peak and your own stocks, if your median P was, let's say, roughly around when you bought was around 40 to 50, and now the company is selling at 120 times earnings, that should at least make you cautious, or you should at least start thinking hard. Again, I'm not making a case that at 120 or 130 it is expensive, cheap, but I would be extremely worried. But again, that's just me. But you need to start thinking. So when you look at the markets getting in that zone of high valuations, take the next step. Look at all the positions which you hold and combine that with your asset allocation framework, which you have in mind. So if your asset allocation has now hit 80% and you're seeing the market also operating in this zone of overvaluation, you need to now start thinking of trimming your positions. And then the vice versa can happen. The market starts getting cheap. Your own asset allocation now gives you a big buffer. You are now at, let's say, 50% allocation. You have a 20% buffer to get into equities. Do a bottoms up research and start, adding stocks over there. Okay. And any other questions, Prince?
Yeah, Rohit. So one question is from Janak. He's asking what would be the way to measure a market breadth? Apologies if this is very basic question to ask in this forum.
No, it's not. I don't have the screens available, and this could become a long discussion. But I think you can chart link. Maybe I have. Yeah, and then I think I again over here, and usually I think these are some of the factors which you can use. Again, I have used these charts from some people who have posted it on social media. Again, on a lot of these things I don't do any original work. I just piggyback on what others have done. But for example, these two are good charts of seeing the breadth, right? So you can see this, right? It's from 2018, and look at the bottom, right? The breadth went. I usually look at this. If you're more of a trader, you can look at this. If you're a long-term investor, you can look at this. And this seems to be this is a 50% median. So stocks below 200, EMA. You can see what happened to the breadth, right? Over here, there is, you can hear the talk, right? The breadth is slowly starting to improve. But see what happens, right? The so many stocks get extended, right, in the technical parlance, and then the market starts correcting, and then they start dropping, right, and then the breadth keeps going down. But the breadth has usually been above 50% since the COVID days. But prior to that, this bear market, it went below 50. So this is this can be a good indicator to look at breadth. And then you have the others also, right? How many are hitting 52 weeks? Again, I don't use these as any sharp formulas. It just gives you a temperature check, right? It's like like the weather, right? What is the temperature? What is the wind? This, that, right? Just trying to get a composite picture. This is a zone of, the indexes are high, the market participation is very high, most stocks are up, right? This is all stocks, not just a particular index stocks. So yeah, you can use this percentage of stocks about 200 DMA. That's one way.
Thank you. So Jatin is asking what happens during a bear market where stocks still have earning momentum.
Often valuations, you will see the valuations kind of keep getting better and better and better, right? So because there is not much buying coming in, let's look at screeners, right? So you will see, these long periods of time, and I think that's something which let's bring up the example which we are going to talk of. So I had IRCON International, right? So let's look at that as an example. Again, disclaimer, used to hold a little bit a long time back. Which again, we don't hold it now. And, just trying to explain what's happening. So look at this, right? Look at what is happening over here. Long period where nothing happened to the stock, right? Look at the PE ratios. Look at the valuation, right? From a valuation of, this particular period before the price, the price started picking up in 2023, right? This is the zone where, the market started recognize this company. Again, Aircon is basically into, I think it's a PSU bank, it's a mini Ratna and into railway construction. So the whole railway theme happened over here, right? Towards the end of 2022, the later part of 2022, and then it really picked up steam. So from 50, it went to 300, 350, 7 times, right? But look at this whole period where nothing is happening. Now, as the earnings kept improving, look at the earnings trough. They were flat initially, but they started improving. The market did not react in the beginning to the question which somebody asked, right? So what happens is the earnings start going down. Sorry, the valuations keep going down. And then at a certain point, like, the stock is like really cheap, 6 times earnings. Earnings are growing up, the market is not reacting because, the overall market is in a bear market, right? And what happens is eventually the market catches on. Theme or no theme, the cure of high valuations is low valuation, and the cure of low valuations is high valuations. That's what, right? If you have to take away one specific point from this session is that valuations are mean reverting over the long run. So as long as the business is still growing, right? There's no iron rule that valuations will mean revert. The business needs to be healthy. It should not be a business which is going to zero or it's going to go bankrupt. It has its own rate of growth. It could be 10, 15, whatever percent it is, right? But as long as the business is growing and if the prices don't increase, the valuation keeps going down. And that acts like a rubber band. At some point, the valuations become so cheap that there will be investors in the market who will say, this doesn't make sense on the cheapness part of it. And they will start buying. So to your example, right, if you find such companies, and that's one of the points which I was making, start looking at companies which are selling below the median valuations during such periods. And I'm taking a historical example that let's say we were in the 2022, 2021, late 2021, 22 kind of a bear market. One such company would have been an Ircon International. You would have seen the earnings are growing, right? The earnings had started growing. I don't have the quarter numbers over here laid out, but the earnings had started growing, right? 2021 was a trough because of COVID, and then the earnings started growing. 2022 it grew, 23 it grew, which means the growth had come back, but the price was not reacting, right? There was no reaction on the price, and let's pull that up. And excuse all the marks and all that, right? I've annotated the chart for my own learning purpose, but you can see this, right? In technical, this thing, you can call this as a very long base formation, right? Look at this, right? It's just been basing for a very long time, from 18 to 20 to 4 years. And then if you are into technical analysis, you can see this earning comes out and there's a huge reaction from the market. And that can be your trigger or an alert. If you're into technical analysis and use those kind of screens, you can, if you were, let's say, sitting at this point of time, right? And you run some screens on price and volume, you will see in this particular zone, suddenly the volumes spike. right? And when you do that, uh, you can see the numbers over here. There was a 47% rise in sales. There was a now to the question which was just asked, right? So I'm kind of weaving that question with this example. Earnings kept coming in, right? This is quarterly numbers, right, which I've laid out. So 46% sales, 65%. This has happened from 2021 onwards, October 2021. And the earnings continue to improve, but you look at the stock price. Stock price keeps going down, right, till the trough of June 2022. And if you look at the June 2022, look at what is happening to the valuations. From here, valuations keep going down, earnings are rising, valuations are going down continuously. And why is that happening? Because the market itself is correcting during that period, right? Look at this, June 2022. So the market is under a downtrend, right? This is what is happening to your market, right? This particular company, same thing, price is kind of dragging down, whereas on the earnings front, you can see, right, the earnings continue to rise. So it is almost that these stocks are kind of setting up, and that is the work we have to do as investors. When the market is is not doing well, so it is impacting all companies, but at an individual company level, like this example I'm giving you, the earnings are kicking in. So there is no price signal which is telling you that this is a good stock. So what you have to do is you have to switch from a technical slash price signal to a fundamental viewpoint. Start looking at the fundamentals, which is the point I'm making. Look at companies which are selling below the median valuation, which are are where the growth is recovering. This may happen at a later point, but at least these 2 points are something which are actionable during such time. And then what happens is then all of a sudden it becomes you know too good to ignore, right? Like this these good numbers are coming in. So here maybe the market thinks maybe one time after such a long history of underperformance, then it says, okay, bear market, people don't care. Good performance, they don't care, don't care. Just keeps happening. Finally, at one point, it becomes the market kind of starts settling down, and then again a good number comes in. And then, at that point of time, you get this market signal also. Price spikes, volume spikes. If you had been tracking, or even if you had not been tracking, this should come into your screen. And then you can say, you know what, numbers have been good, valuations very good. I have the tailwind of both earnings and valuation on this stock. And you will see this time and time again that such markets, the type of market which we are facing now, are a great opportunity to find such companies where people who are not patient, they get exhausted, they leave the market. Companies keep doing well. There's no major event which is happening, right? Like we said about the V-shaped market. Now, economy is doing well. So some companies will start doing well. The price will not. Look for such companies. And then at a certain point of time, when the market kind of is ready to go, these stocks will lead the way, right? And that's what you can see over here. And you can find a lot of examples, which did the same thing. I've just pulled up 3. So let me just stop here, Prince. I know there was this question. I kind of weaved this example into that question itself.
Perfect. So next question is from Rohit Mantri is asking, globally we have seen hardened yield across various countries, including US, Japan, UK, etc. In a high debt world with high yields, do we see higher probability of a black swan event happening? And how do we build the same in our investment framework or strategy?
That's a very good question, very important one. Unfortunately, I also don't have an answer to that. The saving grace is we as a country don't have that problem, and our yields kind of show that, right? We have not spent money like a drunken sailor, right? As the saying goes, right? US, Europe, Japan, to some extent, even China, it doesn't come out, but everybody has a very high debt. And more than debt, you can already see what's happening with gold, right? I mean, gold to a certain extent is a reaction to the debasement of the currency. Obviously, Indian currency has also depreciated for other reasons. My answer to this question, and as a matter of fact, to most such questions, is that if I'm a bottoms-up investor, I usually would look at, see, in a world where all these things happen, your best refuge is still finding attractively priced companies which are doing well. These, just taking this example, right? uh, when Aircon started doing well from a number standpoint, independent of all the other factors in the market, debt was still a problem in 2022. It has only gotten worse, but still you got a 3 or a 4x over here on your money. So kind of, you can break down this question into asset allocation. If you think you are a little concerned on the equity side, the question is, where else will you put the capital? Maybe from an asset allocation starts point, you start putting some amount of capital in commodities, and you diversify into hard assets. And then on the equity side, try to find companies which are cheap and which will do well. Not easy, but obviously, right, if you want to make above average returns, it won't be easy, right? So all such macro questions, that is how I break it down. Two parts, right? Asset allocation, how do you want to move between asset classes? And if you think debt is an issue, move it a little bit more on the commodities or hard assets. And then the rest on our equity portion, try to find companies which continue to do well, because they are not commodity based or other ways, right? They will do well independent of what happens in the world, independent of an extreme event.
Right, thank you. And Piyush is asking how to play deeply cyclical sectors in such a bear market that we are in today, especially the ones like microfinance sector, which appears to be bottoming out as per the
Right.
recent updates by the multiple companies.
I'll take a very open, generic view on that. Let's pick up something, right? I'll just pick up again for illustration purpose, right? Don't take this as a specific this thing. My way of approaching it, again, may or may not be right. I start looking at it from a valuation standpoint. At some point, there is so much pessimism, right, that companies start getting priced for the worst case scenario. Look at the valuations for microfinance companies. Again, this would require a little more discussion, but at a very high level, uh, valuations are not a very good guide for deeply cyclical companies, because at the bottom, their valuations, I picked a price to book, because the book value is still far more stable. If you were to look at the price to earnings, when the company is making profit, you cannot look at P. And this is what happens, at the bottom of a cycle. So cyclical companies are a tougher way to play, but usually you will, it will require patience, because you don't know how long the bad cycle will run. And the one of the best ways to do it is to pick it up at the trough valuations, use different measures. If earnings are negative, use EBITDA. If EBITDA is also negative, then use price to book, use price to sales, something like that, right? Yeah, for a steel company. So you have to do two things in combination. One is you have to pick the lowest possible valuation, and second, if you want to time it a little better, you have to do some sort of staged or progressive exposure. You maybe start with a small position, 1% or whatever it is. Study the sector, and look at when the news stops getting worse. I'm not saying when the news starts getting better. When the news stops getting worse, right? In the case of, let's say, a microfinance company, the losses stop increasing. They are maybe stable, but they stop increasing, right? And obviously, the microfinance company or any company, as a matter of fact, will not go out of business. But keep in mind, this kind of investing takes far more patience, because cyclical companies, the cycle can continue for much longer. We've seen that in chemical, right? uh, they were not supposed to be cyclical companies, but now they are acting like one, and then you have the pressure from China also, right? So a combination of very cheap valuations, and then waiting till the time when the news stops getting any more negative, things start stabilizing, and then you can kind of raise the allocation as the news starts slowly improving. And that need not be numbers. You have to have your ear to the ground, or you should be following the company closely to know that numbers are not great, but they've stopped worsening, and now they're starting to improve.
Right. So another interesting question from Prajit. One thing, Rohit, I can say is this market last 15 months have come to a point wherein the investors are asking very sensible questions. So kudos to all the participants. So
Absolutely.
quickly, I mean, two questions. So how do you reconcile these two views that at an index level, the valuations are either stretched or there are sectors at their bottom valuations? That is one. Second is,
Mm-hmm.
have you done any analysis as to how did beaten down sectors behave as compared to high flying sectors, one before and after a macro shock, the events kind of thing which you
Yeah.
explained initially?
Yeah. So for answer to the first question is, uh, it's quite standard, right? You will have a mix of high flying sectors still selling at higher valuations, and then obviously we just took two examples, right? MFI beaten down sector valuations at almost a 10-year low, right? You can almost already see it in this chart, right? When you look at price to book, look at the this is maybe let's pick another company, AU Small Finance. If there's a 10-year history, let's see that. Max. Yeah, slightly more. Okay. So look at the valuations, right? Almost at a 10-year low, right? Way below the median, right? Versus if you still pick up an EMS, somehow, the EMS sector, which is a high growth sector, no doubts, and a lot of action happening in that. But look at that. The valuations are still on the higher side, right? They may be near their median, but they're still quite high, right? Above 60 times earnings. So that will always be the case. Some sectors will be flying high, some sectors will be flying low. If you are a bottoms up investor in such a market, it's a little tricky to be in during roaring bull markets. Valuations don't make as much of a as much of an impact. And one thing which I see often when investors talk is that uh, they try to look at valuations as if, like, the next quarter the valuation will have an impact. Valuations matter in a 2-3+ year time horizon. Valuations do not matter in less than 2.5-3 years window. 6 months, 9 months, valuations have no meaning, right? That's a known fact from a momentum standpoint. Price just drives its own momentum. So in a bear market like now, where price is not driving the whole thing, you have to look at valuations more closely, because price will not bail you out. And if the valuations are high, the stock could move sideways for a very long time, will kind of, the fundamentals catch up to the valuation. So keep that in mind. So the second question, how sectors behave, overvalued versus undervalued in a V-shaped bombed out market. Yeah, I have done that analysis, and I can tell you, doesn't matter. It's like every company, everything is taken, it is slaughtered. So you will not find safety in. Keep in mind, in those kind of macro events, it is not the fundamentals which is driving the investor behavior. Here in markets like now, there is still a lot of rational analysis which is happening. People are very calmly looking at the companies. They're looking at, okay, where is the overvaluation? They will trim it down. They will buy something. Very steady kind of an orderly kind of a correction is happening. In a 2020 market, nobody is thinking in a very rational manner. When you see the market drop by 10%, all logic gets thrown out of the window. People just want to dump their stock. And so at that point of time, even a sector which has been impacted or its low valuation can get even cheaper. And that's what we saw in 2008, right, where I showed you this particular chart. If you look at this particular chart, right, the 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 the, the market was I mean, it was cheap beyond most of you would not be around, would not have seen that. But there were companies which were selling below cash. Look for this company called as Lakshmi Machine Works. They make textile equipment. They were selling below the cash on their book. I even wrote a post on it on my blog way back. If you search for it, you can find it. which means the market was assuming that this company will go completely out of business. Like it is worth nothing. Book cash on the books was 600 crores or something. It was selling for 500 crores or something. So those kind of things happen. Doesn't matter how cheap it is, it can get even cheaper. So that means you need to just have the courage to buy more than anything else. Any other questions, Prince?
Yeah, so Pranav is asking on a book that gives practical understanding of accounting, financial statement principles for bottom-up investors, not the typical accounting book, but any that gives a feel of how ratios are understood and what to conclude from changes in ratios and financial statements, etc.
Been a long time since I've read these books, so I'll have to think about it, and maybe I'll put it on. I'll put it on. When we post this recording, I'll put it. I'll put it in Twitter or whatever. I'll have to think through it. It doesn't come through mind. I
So,
don't have
okay,
something which comes top
right.
of my mind.
So, Rohit, in case there are any slides left, we can quickly
Yeah,
run through them, and then there are
let's
seven,
do
eight
that.
questions. And I request our audience to now limit their questions because we close around 9, so not sure whether we would be accommodate all the questions, but although we
Right.
try our best to take
Right.
all.
Let's look at one more company. I kind of took you through that example, right? We'll quickly go through these two companies. I think you guys, everybody got the template of what we were trying to do, right? Like how do you look for such companies? Again, old examples, right? Does not mean you have to go and do the same thing with this. Look at the same action happening. By the way, we used to hold this stock. I used to hold this stock. My clients used to do that, and we managed to exit right before the bull run. So it's not like if you know it about the company, you will not make mistakes. So anyway, that's just the background of it. Uh, Same thing, right? Stock doing nothing, right? And then the numbers start coming in, right? And then after some point, the market finally starts acting not as clean, right? But this was part of a theme, the whole shipbuilding defense theme, right? So sometimes it's not just the numbers. Sometimes the theme itself will also play out, right? And if you look at the valuations, right over here, the valuations at some point got extremely cheap, right? Even its own past history, it used to sell at 20 times earnings. And by the time we got into the late 2022, this had become very cheap. So the numbers took some time to come up, right? This is the earnings, but the stock started reacting, right, as the theme started playing out. And then I'll pick up one more company. This we used to hold. Since then we have kind of exited. It's called Vector Foods. This company makes breads and cakes and biscuits and all that, right? This company had an IPO in late 2020. Stock kept going down. Maybe I think from what I remember, the valuations was quite high in the beginning, right? 80 times earnings, and then obviously, right, the numbers were a little weak. But you can see, right, towards the later part of 2022, compared to other FMCG companies. So it need not be some hot theme or things of that sort, right? Can be any company. Valuation started going down, they troughed over here. You need not have picked the absolute bottom over here, right? Because this is hindsight bias. You can always say, oh, the numbers improved, and hence you would pick this bottom. The point is not picking this bottom, right? It's not like it something touches the bottom because the numbers are still weak. You can pretty much wait, let the numbers start coming in. The numbers started coming in over here, and keep the same framework in mind. Valuations started were below average, right, compared to the sector. If you look at Britannia and other companies, much below that, right? The market was going sideways. The numbers started coming in, and then maybe at certain point of time, when 2 quarters the numbers were good, and you see that the company is now breaking out from a very long term base, right? Not very long term, but roughly a 18-month kind of a base, and you can start analyzing it in this area, right? So the theme is the same. You will see companies which have started doing well or already doing well. Their valuations are getting cheap and cheap because the market is under pressure, and people are coming up with various reasons. They're saying, oh, this particular event has happened and this macro issue is there, and this interest rate problem is there. But individually the companies are getting cheap. Start identifying those companies, right? You can start adding to that. And let's come to the last point on this slide. Now let's say you've done the work. You found these companies, you've added to them, but you're getting no signal from the market, right? Because the price is not increasing. You feel as if the your portfolio is not making any progress. That's where the whole disappointment and the whole impatience kind of comes in. What I would suggest is look at your portfolio as a stock. That concept, right? What I've shown here is a table where I'm giving an example. What I'm saying is, let's say you have a stock A, you have so much quantity, just calculate the total earnings. So let's say you have a certain amount invested. In this case, we're saying we have 6.5 lakhs invested across 4 stocks. This is the EPS, this is the quantity, this is the earnings of the stock, right? Total earnings your portfolio is making. So your portfolio of 6,50,000, this concept of, you can read Warren Buffett's letters, it's called as look-through earnings. What it means is, what is the earnings of your portfolio based on the stocks you hold? So a portfolio of 6,50,000 is earning 44,000 per year, right? Because these are the individual earnings. Look at the PE for that. When I'm saying earnings growth, you can look at past growth, or if even better, if you can just do a rough estimation of what you expect the earnings growth to be for the next 3 years. And what you can then do is to evaluate what is the PE of your portfolio and what is the earnings growth of your portfolio. And your objective in such markets where you're not getting a price signal is to ensure that you have the highest possible earnings growth with the lowest possible PE. And that should be very obvious, right? Because that's what we do at a stock level. Those are the examples I gave you. So we saw 3 examples, and where we said earnings are growing, the valuations are cheap and going down, and then it was just a matter of time when the market started recovering, that the stock started recovering and became a multi-bagger. Same thing will hold true for a portfolio. What you're doing is you are exiting companies. If you use this framework, you are exiting companies which are highly valued, or where the earnings growth has slowed down and you don't expect the earnings growth to pick up. Replace that with a company which is either cheap, or better yet, which is cheap and has a reasonable earnings growth. That will improve the PE for your portfolio. That will improve the earnings growth for a portfolio. And I've done this for my own personal portfolio for almost 15 plus years. And actually, what you will realize as you tabulate this data for your portfolio, there is a high degree of correlation between these two numbers and your portfolio performance. As this gets low and low, right, there will come a point of time where, as the earnings growth go up, this will start improving, and you will get a double tailwind, both for the earnings growth and from the PE rating, PE re-rating. And that happens at the company's level. So obviously, when you have 10 such companies in your portfolio, it will happen at the portfolio level. So if you have to look at something while the market is in a flattish kind of thing, look at how fast the earnings of your portfolio are going up. If the price is not acting, but this keeps going up, the valuations will keep getting cheaper and cheaper, and it's just a matter of time where your portfolio will do well. So we'll just end it with this particular slide. In the end, no matter how much of math or analysis you do, you have to be a long-term optimist. It's a matter of faith, right? I call it rational optimist. There's a book called as, I think there's a book called as The Rational Optimist. Do read that, right? It's an excellent book about how it pays to be a rational optimist, which means that there will always be problems, but humans and humanity have always found solutions to problems. And over the long term, we've all done well over time. And whether you look at the country level, individual level, that is what happens, right? We work through our problems, we find solutions to it. When climate change happens, we start going into solar, we come up with electrification, we come up with EVs, right? All kind of things happen, right? And that's what we do, right? Companies come up, we solve problems, and that is what progresses the economy. And that is what you should think of, that eventually the market will come back, and your job during that period is to look at your portfolio level, ensure that the earnings are going fast enough and the valuations are cheap. And I'm sure, and then the portfolio will do well also. So we'll stop here, Prince. Any questions? We can take that before, we
Yeah, there are
get.
7, 8 questions, so we'll see. We'll try to wrap up in 10, 15 minutes, Ravi.
Sure.
So, Dr. Vipin Agarwal is asking, can you please share some view on the asset allocation at this point in time? And by any means, if you're tracking any views on precious metals, I know the market has stretched on that, but again, your views on that. And then subsequent question similar to this is like you gave example of Cochin shipyard, right? So
Right.
any particular theme you are looking with a horizon of 2, 3 years, which looks good to you? So these are 2, 3 questions.
First, yeah, three questions. The first question is easy. The next two ones are very tricky for me to answer because of the regulatory concerns. Regulatory, as in what as an advisor, I'm allowed or not allowed to say. So on the first one, asset allocation, there is a certain amount of subjectivity, but I would say in general, based on your age, income level, etc., the thumb rule which a lot of people say is 100 minus your age. So let's say you're 40, 100 minus 40, 60% equity allocation. That's a very standard thumb rule. But again, easier said than done. But I would say, think of the major asset classes: equity, real estate, commodities, fixed income, four, right? And uh, equity, obviously highest return, highest volatility, 50, 60% is usually a good enough. It will give you a good alpha or whatever, good return on your portfolio, but you will not lose sleep if the market drops 30%. And the rest of it, you can either do it through, actual investments, or, through whatever, any instruments which are there. So that I would say is from an asset allocation. Again, it's a very individual 1:1 kind of a discussion. Cannot answer that for a very large audience. Precious metals, I would I would avoid answering because, full disclaimer, we have held it for our clients. So by answering that question, there could be a conflict of interest. So, I will avoid, answering that question directly. All that I would say is that now, you know, I am one of those investors. I've written about it on my blog. I used to be totally anti precious metal for a long time. And then maybe a couple of years back, I changed my mind as I started understanding and learning about technical analysis, because earlier I did not have the tool to figure out when to buy. See, there are obviously two ways to buying precious metals like gold, right? One is the traditional way which our families have done, right? They will buy it independent of all of this story and gyan and everything, right? They buy, our families, our parents, they would buy it whenever they had the capital, and they will not worry about the Ukraine situation and the interest rates and all that. That's one way of doing. The modern investor, we want all narratives around it. And we obviously, you can look at charts. So when I had the tools to be able to figure out, you know, how I can analyze it from a chart perspective is when I started getting involved. But I leave it at that. I also don't know, right, what will happen around it. It's a little tricky space, and requires, far more swift action. So that's the, from this for the second question. In terms of themes, that's there are a few themes which are very long term oriented, which we some of us are, a lot of you would be aware of. Things like the whole CDMO space. Again, I'm not recommending anything, but that's an area to keep an eye on, right? You will have these bursts of optimism and pessimism. So that's one area. Pre-engineered buildings seems to be a long-term trend. That's one area worth exploring. Electrification, it keeps getting talked about a lot. I think it's a long-term trend with its own ups and downs. There are sometimes themes like CDMO and electrification which will run for 10 years, but oftentimes they will have its bursts of optimism and then its pessimistic period. And you have to, if you believe in a decade theme, it does not mean it will work every year, every month for the next 10 years. There will be ups and there will be downs. So you will have to pick your spots, your companies, and timing, but the overall tailwind will persist. So you can always look at that. AI is one theme, but it is so much in the news that whenever such a thing happens, I usually just step away from it. The prices become totally disconnected from reality, and I've shown you over this entire session, right? That at some point, when valuations are too high, a correction is inevitable, because only a small thing has to go wrong for the corrections to happen, whether it is stock sector or a market. That always holds true. So anyway,
Right.
that would be my
Thanks.
response to the third question.
Right. Thank you, Rohit, for this. And Abhishek Avasti is asking, how do you approach the valuation of new age companies? Many of these businesses are still loss making or have just entered the early stage of profitability. So, which makes conventional valuation models challenging. How do you assess their long term sustainability and justify current valuations, or you keep yourself away from such companies?
I'm not dogmatic, or I don't have a specific this around any new age company per se. But yes, I am sensitive, very sensitive to valuations. There are a few red lines in the sand which I don't cross. For example, the first thing which I do is I will not look at valuations, but I will look at the economics, right? And believe me, I may not be the right person for some of these things because I've been proven wrong. But uh, if the economics of the, so one thing which you have to do for these new age companies is you have to understand the business model. In some cases, the business model is not so easy to understand, because there are so many moving parts that maybe at a unit economic level, which means, what I mean by unit economics is that, let's say you're a quick commerce company, or let's say you are a ride share company. Per ride, per order delivered in quick commerce, or per policy sold online, the company may still be making a good amount of profit, but because it is growing very rapidly, it is losing money. So you have to figure out, right? You have to do some projections and figure out, what is that steady state kind of profitability. A steady state means you move from a hyper growth phase where it is growing 40, 50, 60% to a more traditional high growth, but a more traditional growth of 20, 25%. What's the valuation, what's the projected valuation earnings at that point of time? And often what I've found is that there is so much optimism built in during that hyper growth phase. So keep one thing in mind: when hyper growth happens, investors get very, very excited. A company growing at 15% versus growing at 30% will not see a 2x in valuation. It will see a 4x valuation. At 40%, everybody gets very excited. So a company which is growing at 50, 60 percent, oftentimes will attract a very high valuation, and I tend to stay away at that point of time, because then if I'm wrong for whatever reason, the downside risk is very high. But that said, I don't ignore it, but it requires more work to be done. Right? You have to do the right projections and figure out.
Thanks, Rohit. And I sincerely thank Mr. Khilaf Singh for taking the lead and sending these smileys on behalf of all the participants. And thank you so much. So, one question is from Baljinder Singh ji. He's asking, sir, if your portfolio companies have good earning visibility and portfolio valuation is not obscene and the PEG is also less than 1.5. So what would be your view? I mean, you will be, view in the sense that is an open question from Baljinder.
I see, if you are still going to every quarter when the numbers come out, you will revisit your portfolio, the numbers, right? So when I shared this I do this for my own personal portfolio, and again, obviously my personal portfolio matches my client's portfolio. So in a sense, I do this. I don't share it, by the way, because I don't, because there is subjectivity in this, right? This number and this number is objective. Earnings growth is my projection of growth coming in for the companies. Every quarter when this happens, I will look and I will re-estimate this based on management commentary, how the numbers are coming in. Let's say I had estimated that this company will grow at 30%. And then all of a sudden, the management says, no, some situation has developed, lost a customer, something happened, and this goes down to 20%. So obviously the earnings growth for my entire portfolio is down. Does not mean I'm going to panic and exit this particular stock, but it means that the earnings growth has gone down. Maybe by the end of the quarter or during the course of this, I may exit a position and add a position to improve on these numbers. So that's a constant effort which is happening. It is not static, right? The numbers, companies are performance is coming in. In some cases, the PE continues to drop. The earnings growth is just steady, so you will do nothing. Sometimes the earnings growth will disappoint, and then you will compare it with the valuation. If this stock, which is growing at 30%, the valuation is at 50 times, it will get corrected immediately, and I'll have to take a decision on it, right? Versus this one is a very attractive, growth at a very reasonable price. As long as 15% is coming in, which is not a high bar, I don't have to do anything. But at an aggregate level, I just need to ensure that the earnings growth is kind of being maintained. 20% earnings growth at a portfolio level will be exceptional, right? And if nothing is happening from a price standpoint, this keeps improving. And if this keeps improving, then there's nothing to do. You just have to just be patient and think of it this way. Do this exercise for the last 10 years for your portfolio, maybe 20 years. And what you will do, not 20 years, that may be a bit too much. I can do it, but maybe most of you cannot. Um, Look at it for the last 10 or 12 years. What you will realize is that over time, as earnings growth comes in, this will improve, and that's what will improve the total value of your portfolio. So take heart in the fact that as long as earnings is coming in and valuations are good, all that you have to do is just be patient and wait. You are making you are creating wealth. It's just that the market has not recognized it yet. Just keep that in mind.
Thanks, Rohit. So, two questions on US market, and I think we'll give it a pass to other questions because that keeps on coming in never-ending loop. Again, we can have a session, open-ended session for that because some
Sure.
questions are basic, which were covered in the last session. I'll share with you guys on my X. So basically, portfolio construction, or these are basic questions which were discussed last time. So he's asking about the international investing case, how to go about it, and in which market are you interested further, how to go about the cash calls in the sideways market or a bear market. And Piyush is asking view on the US mega caps, that is the Mafang stocks, top 7 US stocks.
That the US market and the FANG stocks, I what I can tell you is that at least again, just my view is that their valuations are fairly reasonable. Obviously, right? We've seen that these are phenomenally profitable companies, but at the same time, they are the consensus. They are the global consensus trade, right? So like now, anybody and everybody is a fan of these stocks, right? And what we have seen in the past is that if and when a correction happens, these stocks also can drop 30-40%. Google has dropped 50% in 2022. Look at the numbers. Meta or Facebook dropped 50% plus. Tesla also same thing, right? So all these large companies can drop. They are not a safe haven. Uh, from what I know of, I have not invested through an Indian broker, but from what I'm aware of is that the process of investing is also not simple. So again, I cannot give advice in terms of how to go about it. You'll have to reach out to your broker, speak to them, also understand the tax implications of it. That's the best I can tell you. Our clients have brought this up, but the feedback I got from our clients is that it requires, there's a lot of administrative load to investing, in foreign stocks. So just keep that in mind. But outside of that, the US markets have been, the place to go. And it's just me personally, but when everybody goes to a party, I generally avoid it. Maybe that's the value mindset which I come from. You know, Now I've obviously paid the price of missing out on such large gains. But honestly, if I am uncomfortable with that, I will not have the courage to hold it when even a small comes along the way. So then I don't deserve to make that money if I don't have the patience or the courage to hold that stock. So that's why I would be cautious in terms of getting into a space where there is so much excitement.
So one quick question, last question, of course, Deepak Juneja is asking, after a completion of a bull bear cycle, do you see the same leaders or a different set of stocks as per your opinion coming?
Most of the times it's a different set of because what happens is in a bull market, one sector, one segment will run up, right? And the reason, and in a let's continue with the same topic, that the bear market is a valuation led bear market. It's nothing to do with an external event. The correction starts, right? It's the most overextended sector which will get hurt the most, and then the others will kind of will kind of correct also, but not as sharply, right? I mean, we saw that during the last cycle, right? If we pull up, let's say, a Balaji Amines, right, which was the go-to company in the last cycle. Look at this, what happened, right? It went up to this point in 2021, right, from a fairly low base, and then it has just been going down all the time, right? So this Balaji Amines and these chemical companies like a Navin Fluorine, all these companies never kind of have they're still, look at where it is, right? It was 4,600 at its peak, and now it's 1100. It is still 60 70 50% plus down, right? 60 70% down. So in the interim, we had this bull market from 23 to what, to now, right? 25 or whatever, early 25. But what did Balaji Mines? We did nothing, right? So usually that is what will happen. A very long cycle of overextending the valuations. If the numbers still remain, that is good. If the numbers don't recover, then you have peak valuations, peak earnings, which is the worst combination. But if you have just peak valuations and the earnings continue to increase, then at least it will go into sideways, and then eventually when it gets into the the undervaluation zone. So we go to Balaji Amines, and you get into the undervaluation zone, right? You look at Max, right? Go look at the cycles, right? Used to be so undervalued, then got undervalued. Now the earnings haven't caught up, right? The earnings have been going down. So it's only when the earnings start picking up and this valuation then enters into some sort of a median or undervalued zone, then the stock will kind of pick up, and that usually takes a long time. Depends on how quickly the earnings come back, and then when the market catches the fancy. So it's the same cycle again and again, which is why I made the comment in the beginning. Whether it's an asset class, equity as a whole, whether it is, I mean, even real estate operates in the same way, whether it's a company or a sector. There are these long valuation cycles which play out, and that's where these long term, these kind of grinding bear markets happen as the markets or the companies kind of uh, get back to their to their median levels.
Perfect. Thank you so much for such a long yet very, very insightful session, Rohit, and gracefully you took all the questions, and I can say that with great sincerity and honesty that we really loved the session, and all the answers, well backed by data and experience, were greatly helpful, at least for the participants who have been very serious about the markets and were in I mean doubt, or you can say dilemma, what to do in such markets. So definitely comforting in the sense like the parallel which we drew while explaining with the past, that these things happen and how we can position
Right.
ourselves and be in the market is something which definitely help us big time. And it's always, as you say, that we keep on evolving and learning new things is something which is need of the hour. So thank you so much for your time, Rohit,
Thank you,
and
Prem.
maybe any closing remarks from your end would be helpful. Yeah.
No, I think all that I can suggest to everyone is, just be a long-term optimist and have patience. It always works out. That's all I can say. And hopefully, we will see better times soon. So thanks, Prince, for hosting this. Really appreciate it. Thank you, everyone.
Thank you, Rohit. Thank you, Manthan, and thanks all the participants. And I hope we covered all the questions directly, indirectly, and it is really helpful for all of us. Thank you so much.
Sounds good. Thank you,
Yeah.
everyone. Have a good day, all of you.